Hi, Andrew Bell with you again, as real estate continues to dominate the national agenda on many fronts, and most recently about the planned changes to negative gearing. Real estate has to be one of the most taxed investments or commodities in the Australian tax program. When you're saving for a deposit to buy a home, you pay tax on your deposit, which slows down the ability for people to accumulate sufficient funds for a deposit on their property. When you buy one, you then pay an outrageous state stamp duty tax, and then you pay taxes in the form of GST on rates each year. If a property is leased out, you pay taxes on any profits. And many people qualify to pay land tax during the course of your real estate holdings. And then ultimately, when you sell, if it happens to be an investment property, the government wants a slice of the profits as well in capital gains tax. Name another form of investment that is taxed more than real estate. The proposal by Bill Shorten to only allow negative gearing on newly constructed properties is only going to set us back in the same position that we were in the 1980s, where investors won't be able to buy resale properties, so there will be no new rental properties in established areas, and will force renters to move out well away from the central markets and in many cases from their children's schools or their places of employment and away from their central families, because rental properties will only be in brand new estates in the outer areas. This is not about taxing the rich, it's about encouraging investors to actually buy properties to meet the huge rental demand that governments can't meet. A very naive approach, certainly the undertaking present, and taking away the ability of Australians to become self-sufficient in their retirement in later years, as it will turn off many buyers from actually investing for their future. Enough of that for the moment, and undoubtedly there will be a lot more modelling done, and hopefully people will see it for what it is. So today, we're having a quick look at the second fundamental that drives real estate: interest rates. It's a very crude tool, but an effective one in controlling spending in the economy, and in particular spending on real estate. Lower interest rates and people will borrow to spend. Put interest rates up and they don't. The Reserve Bank is constantly watching a range of activities such as unemployment, the Australian dollar, inflation, consumer confidence and so on to determine the best policy. As we know, we are in record low interest rates now, and that's been an intentional strategy to try and stimulate the Australian economy. The three biggest influences on interest rates presently are: one, the economy, with the Reserve Bank in a wait and watch mode. Second, the Australian dollar, which they'd like to see around 65 cents to the US. There's a tendency to drop interest rates to weaken the Australian dollar. And the third is Sydney and Melbourne real estate prices. There was a strong inclination to put interest rates up pre-Christmas because of the strong rises in prices in those two markets. But that did ease off in late 2015. However, there are signs now that those two markets are actually still running quite strongly. So it may be a temptation to put interest rates up. The Reserve Bank has also been keeping an eye on inflation, which is around 1.5% and well under their target range of 2 to 3%. So this is the quandary the Reserve Bank's in at present. The lower inflation rates would give them the scope to reduce interest rates, as they'd like to see the inflation back up over 2%. If Sydney and Melbourne actually see price growth rising again, there'd be also a tendency to increase interest rates a little. However, when the US raised their interest rates late last year, it had the desired effect on weakening the Australian dollar. So there's no real need on that front to reduce or increase interest rates. The latest economic figures, as late as late last year, also showed an increase in economic activity. So again, taking away the need to reduce interest rates. A whole lot of conflicting influences there. I think the most likely scenario is that there will be no change. The Reserve Bank will play the wait and watch scenario, and they're generally conservative. So whilst we're likely to continue in low interest rate environment, which we have right now, at least for the immediate term, once we see a longer period of strong economic growth, and also watching what happens with unemployment, which did fall pre-Christmas but has now risen just after Christmas. We've also watched the Australian dollar. If that can stay below 70 cents, then it's probable that the environment is that the Reserve Bank will look to increase rates. It's not likely to happen anytime soon, but that is the most likely next movement, unless there is a sharp downturn in the Australian economy or a significant increase in unemployment. Keep a close eye on the unemployment rates, as I think it's going to be a key factor in any interest rate decision. But for now, it's most likely to be on hold at the current levels. On a longer term basis, home loan interest rates are tipped to stay at historic lows for the next decade, and that's below 7%. On a side note on that point, I'm still shocked that more people aren't locking in fixed interest rates. It's highly unlikely we're going to go any lower, and there's more of a probability we'll go higher. When the Reserve Banks move to raise or reduce interest rates, they don't just do it with 0.25% change. They usually do it over 2 or 3 months with 0.25% change each month, with a bit of a pause before perhaps some more rises after that. Once they start to move, I can imagine them going up about 1%. So don't miss this opportunity to lock in these low interest rates while we have them. I've got on our screen our loan market hotline. Give us a call on that. We'll get our loan market contact to do a check for you to see if they can find a really attractive interest rate amongst the 40 different banking institutions that they work with. That's it for this week. Look forward to catching up with you in a fortnight's time. Thanks for your time.